There is always a debate about which investment is better, property or stock. The question of whether or not the property beats the stock market as an investment depends on the perspective you take. Let's look at some historical data and facts. In the end, I will share a very secret fact about where the rich people keep their money. So do watch this video till the end and you will be surprised by the figures. Before we look into the factors of comparison, it is very important to understand that property for a personal use and investments are two different concepts. Most people mix this up. When you buy something for a personal use, then it is not fair to compare it with the investment, as the intention of both are completely different. Alright, now let's see the three factors of comparison. So the factor number 1 is returns. Here the question essentially is which investment generates a greater profit, but this isn't an easy to establish as you might think. It is important to remember that there are many hidden costs involved in both property and stock market investing. The former will carry a maintenance cost and repair which affects your portfolio, while the latter could be affected by the excessive annual investment management fees that depletes the rate of return. There is also the investment timeline to consider. How many years should your comparison analysis be over? And in addition to this, which properties or stocks are you comparing? For instance, a property in one part of a country may rise in value while others fall. Certain market indexes are also likely to vary in performance. One interesting study is the research conducted by the Credit Suisse Research Institute, which compiled data over last 118 years to find out where the property outperforms stocks when it comes to the rate of returns. They found that on an average, investing in UK stocks between 1900 and 2017 would have net a 5.5% rate of return each year, while house prices rose by 1.8% per year. So despite popular belief, property does not necessarily provide a better return than a stock market over the time. Now the factor 2, taxes. Many believe that property holds better tax benefit than the stock market, yet this area is complex. Take capital gain tax as an example. In 2023 and 24, you can earn up to £6,000 per year in capital gain without incurring any tax liability. This applies to the sale of owned property, excluding your main residence home, and to the stock market investments which you might sell after they have increased in value. However, stock still arguably have an edge over property as far as taxation is concerned, for at least two reasons. Firstly, you can shelter up to 20,000 of stock market investment within an ISA each year, where the gains made on the investment are exempted from the capital gain tax. This is not possible with a buy-to-let property. Secondly, you can buy and sell your shareholding over the time, possibly keeping everything under 6,000 annual tax allowance. However, capital gain on property sales must be dealt with all at once and are likely to far exceed this allowance. And now the factor 3, risk. Investment risk is closely linked to the rates of return. And as a general rule, the greater the risk, the higher the level of potential return from an investment. So in theory, since a stock appears to offer a greater returns than property, the latter should be less risky. Over the time, the stock market is likely to be more volatile than a property market. If you choose not to invest for a longer term, which is at least 5 years, then stocks and shares could be considered a more speculative investment depending on how the market has performed. However, there are at least two ways to mitigate this risk. First of all, diversifying your portfolio across different types of holdings, geographical areas and asset types can help spread the risk. Secondly, stock market have historically grown over the years despite short-term volatility. By staying invested in the market when prices fall rather than panic selling, you can often weather the storm and benefit from the eventual upturns when market recovers. Of course, it is important to note that property investments are not inherently risk-free or immune from volatility either, as the 2008 financial crisis should remind us, and even the current property market situation in Western countries. Now let's see another interesting fact about ultra-high net worth individuals, the rich guys. Where do they keep their money, and is that something we can learn from them? Looking at this 2018 Credit Suisse report, high net worth individuals keep their 25% of their portfolio in the financial assets like stock, bonds, cash, etc. 24% in real estate. Very important to note that it is excluding homes, and 23% in personal businesses. What this indicates is prominently these three asset classes make you rich. These three asset classes pave the path to the prosperity. The point I am making here is we must choose at least one of these asset class, if not all three, to secure our and the next generation futures. Out of these three, the simplest and the easiest is investing in the financial assets to start with. This video is for information purposes only. It does not constitute investment advice or financial advice. I hope this video provided you with a new perspective. So to learn more facts like this, do consider subscribing the channel, and I will see you in the next video. Ciao.